computer science, business school. Did my first third of my career in management consulting in the DC area, as well as here in Chicago. The middle third in product design development, startups in California, and then the Motorola design team. I also then started a company called Demybooks, which was a publishing platform on the iPad. We sold that in 2015. I was at the Motorola design team before it got acquired by Google, then did Demybooks. And the last 10 years or so, again, have been investing in early stage innovation. Go ahead, Nicole. In terms of, you can flip the slide. Yeah, so DiPaolo is based here in Chicago and also in Lisbon, Portugal. The story of how I got to Lisbon is really similar to how many people end up in Portugal. You take a vacation, you fall in love with the place, and then you decide, hey, how do I sort of bring some calm to my otherwise crazy life by having some exposure to the pace of life in Portugal. So it started with that, but then it became a little bit more of a how do we sort of integrate into the VC as well as the startup community, and then eventually started a parallel fund to what we do. But what we do is advanced manufacturing for people on the planet across energy, climate, physical AI. And in the past, it used to be connected devices, wearables, but a lot of that, everything in technology that's collecting data now is legitimately looking at what AI use cases make the most sense. So we'll dig a little bit more into what that means for us. We really differentiate because we're technology experts. We come from software, hardware, data science. It's an ex-Motorola Google team as far as the general partnership. And a lot of our team members end up being people with engineering and science backgrounds. We institutionalize that through what we call the residency. It's both part of how we do diligence on companies and also how we support our portfolio companies post-investment. And essentially, software by itself doesn't solve the big challenges that we face across climate, across health. And you really need to embrace hard tech. And lots of capital these days are flowing into that. We'll get into it. Raquel, you can move forward. So this is our first fund. Some of the breakthrough technologies that are things that we've invested in, they range from a cancer detection and biopsy technology called NovaScan to Throne Labs, which just hit Series B. And we'll talk about what these different stages of funding mean. And they essentially are a luxury bathroom experience without the need for plumbing or sewage. That's the innovation or the IP. So communities can put these mobile bathrooms in parks, in public areas, on the sidewalk, and they've been very well received. The company's scaling nicely, and that's what you want to see in a venture portfolio. We also have one exit, Geobit, which was a kids and pets tracker. It was sold to Life360. I've been involved in Geobit because I knew the founding team, was one of the first investors, and then invested multiple times through different vehicles. We also have a fair number of energy and climate plays in our first portfolio. And then in the second fund, both in the US as well as in Portugal, the energy climate equation would be higher, but we'd also still do physical AI type of applications. You can, switch. So as I was saying, the Geobit story, first angel check, or one of the first, and then my GP partner Mitul became involved because he did the PCB or the circuit board design for this product. The product is on the top left, the top right. You can see it's not much bigger than a dime, but it's a great tracker. So it works across across the world, across all sorts of mobile and GPS and Bluetooth and Wi-Fi networks, and was a great way to sort of know where your child was. It could attach to a backpack, shoes, belts, etc. And then they came out with a product for pets as well. We also invested multiple times, as I was saying, through different vehicles. And then the IRR and MOIC, I'll explain what these things mean if we need to, but has been a very decent sort of outcome. So you can see the money over invested capital, 1.64, or 4.72 or 3.68. This means how much more, what kind of return did that generate? And it's a good indicator, getting a 2x, 3x, 4x is decent. Not everything in venture investing is going to be 10 times your money. That's a nice target, but it's not possible. The IRR is your net return, and it's a factor of how long an investment takes. So if an investment if you can exit faster, your IRR will be higher. So sometimes for the same investment, this IRR number changed because, for example, the first fund held this for a much smaller amount of time, whereas me personally, I've held it for many more years, so my IRR is lower. We can move forward. So let me go into what's happening in venture capital. Raquel, we can go to the first slide. Yeah. So let me go into what's happening in venture capital as of the third quarter, end of September. This is PitchBook data, so everyone has access to it. But a few key takeaways. I mean, first of all, venture capital is investing in early stage innovation, right? So when companies first start out and it's seed and A rounds, B rounds, etc. There's three stages of venture investing: early, middle, and then sort of early growth, and then pre-IPO, I guess, the much later stages. So this is across all of those stages. And the big macro factor is that after the pandemic in 2021, there were lots of deals. There was a lot of capital going into startups, and everything just got into a bubble, and it got overvalued, and people were paying really high prices. It started to all come crashing down after that in 2022. The money started to dry up a bit. So you see 23 was a bad year. But it's starting to trend back up. So in 24, you had more deals and you had more capital. And certainly in 25, we're back to the 2022 levels as far as more capital, more deals. So that's good news generally. In terms of where all this capital is going, a large part of it is going to AI. And within AI, of course, there's the pure play software AI, but a fair amount is going into hard tech AI, which is an area that we play in with physical AI. So that's good to see. And hardware and robotics having 17% of that market is good for our platform because there are more investors willing to come into that area. Obviously, the US still remains the engine behind this in terms of VC deal activity. But what LPs or limited partners in funds will look for is liquidity. How much time do we have to be in holdings? How do we, get capital out, etc. So the IPO market is a good indicator. Not that every investment we make ends up being a public IPO. Few of them actually do. But overall, if there's more IPOs, then that's a sign that, at least somebody's having liquidity, and that starts a trickle-down effect. There's more M&A, maybe. A lot of our investments end up being bought by another company, a more mature company. And so you want to see more IPOs, you want to see more liquidity in the market. Hopefully 2026 continues to be a good year, and these graphs start to, keep going up. Go ahead, Raquel. Just a few more takeaways. We'll share this deck with you. So if you can say global venture investment has stabilized, I don't know if everybody will completely agree with that. And as far as late stage activity, that's that stage before IPO. I'm certainly seeing in our first fund, I talked about Throne, the public bathroom. So we invested in a seed stage in 2023 in the fall, late summer. By the winter of 24, they were at Series A, and then now this summer they just did a Series B, which is very fast timing, for hard tech deals, and we participated in the Series B as well. So this later stage would be Series C's and D's and E's, and that's also picking up. I think there's been a rotation as far as Europe goes. A lot of European innovation tended to be in the northern countries, such as Scandinavia, Germany, obviously. Recently, just on a macroeconomic trend, one of the things you're seeing is that the countries in Southern Europe that put in austerity measures, like a a Greece, like a Spain, and even Portugal are now doing relatively better in terms of the economy, etc. Raquel, we have some folks in the waiting room, if you want to check that. In terms of liquidity, I mean, I just spoke about that. I think technology, if you follow the market, a lot of the news this year has been around, AI, right? And then powering that AI through more compute and more data centers. And then where is the energy that's going to feed the data centers? What are our sources? Is it going to be alternatives? Is it going to be traditional energy sources? And so in the macro environment, this really sets up a very interesting play. Is this AI and data center capacity overhyped, or is there a bubble there? Is the overall market and capital moving towards only those types of investments, going to come crashing down? So these are some of the things people are grappling with, whereas the other school of thought is no. This is at the very beginning of the AI sort of wave, and we need to accelerate, not slow down. And at the end of the day, what's passionate for me is how does this translate to the energy climate nexus, right? So yes, we can have more data centers, more AI, but can we be climate conscious? Can we make sure energy use is done smartly? Can we find savings? And that's the type of tech that we like to invest in. Raquel, go ahead. So let's generally look at why you want to be in venture capital and why you want to be in startup investing, whether it's directly, whether it's in angel groups or funds. Essentially, you're looking for diversification. So if you've got a lot of exposure, you're building your portfolio in public market investments, you're buying these large companies that make up the NASDAQ or the S&P 500. That's great. 401k accounts, retirement plans. So you want to balance all that out. What private investments like venture or public equity or even real estate investing do for you, they're called the alternatives, right? So they give you exposure, they give you private market exposure. And like any smart portfolio or asset allocation strategy, you want to have balance. And so VC can give you both growth potential because the exits can be high, and if you do a bunch of startup investing, potentially, and you should have higher returns. That's a theory. You're not investing for the same return that you get by buying the S&P 500. Over time, you want a higher return. You want to add balance. You want to obviously have exposure to innovation. Depending on who you are and your propensity and your skill set, you may have active involvement because many LPs come into funds like ours and say, I really want to help mentor, or I want to give something back, and I have expertise in manufacturing or in finance or distribution of products, and I can be a mentor. So our residency, for example, allows for our LPs to plug in. Many investors in funds and such, or even angel groups, will write the check and want to be hands off. That's one of the advantages. We can pick and choose. But if you are doing private equity or running a private equity sort of vehicle, then you are more involved, and that's one of the differences that we'll talk about. In terms of risk and taxes, so on risk mitigation, I think the point there is you don't want to make one investment. You don't want to invest in your neighbor's cousin or your cousin's neighbor and then put all your money there and see that it fails and then you've soured to the whole asset class. You want to make, initially, if you're starting out, you want to make smaller angel-sized checks, and that can mean different things for different people. Some people start out with $2,000. Some people start out with 10 or 25K. In a fund, you might have to make $100,000 investment or $250,000 investment. Some funds will let you in for 50 or even 25. It all depends. And those larger fund investments can be done over a few years, and we'll get into that. But if you invest in a startup, typically they want one check and it's right away. So I think funds sometimes, venture capital will allow you more diversification, and therefore you're mitigating some of your risk. Tax advantages depends on which country you're from, as far as your tax filing. In the US, if we hold an asset for longer than 5 years, and that company meets certain conditions, then it's possible that the capital gains will not be taxable. So that's a great advantage. That doesn't mean that every company in, say, a 20 or 25 company portfolio will be eligible, but the Section 1202 does allow for that. There are other tax considerations as well. You can also invest from your retirement account, a self-directed IRA. So often people don't realize that. And that's a great way to participate in, say, a US fund. If you're in different countries, everyone's got different tax rules, and you want to look that up. Go ahead, Raquel. So I've already mentioned this a couple of times. Essentially, there's three ways to invest in early stage innovation. You could write angel checks directly. You could go on a platform like AngelList or Republic, and you can find very young companies, or you can find pre-IPO. Like if you want to put $5,000 into Stripe or SpaceX, you can find a platform somewhere where you can do that. So everyone that starts this journey does some direct angel investing. I have as well. Angel syndicates is when you're part of a group, and this is where you have some theme. It could be, hey, I want to invest in early stuff coming out of Chicago or Lisbon or the Iberian Peninsula, and or I want to invest in fintech in the Midwest. So every angel group has its own theme. Some are organized around their geography, some are universities, and somebody usually runs it, right? I started one called Nameless Ventures here in Chicago with a couple of other guys. We did this around 2016, 17, ran it for about a year. We made four investments and knock on wood, got fortunate, or also we're good at it, I think. Three exited, and the other one is a $2 billion unicorn now. Only one was in hard tech. So that's a great way. There are other good brands in every city out there. So wherever you are, if that's the way you want to start, join a group. If it's a smaller group, then you need to bring some expertise. Sometimes you'll have to go source the deals. Typically, there's a meeting, members get to vote, and then individuals decide if they want to invest or not. So in the first and the second options, the real differentiator there is you decide if you want to be part of that deal or not. In a venture capital fund, you're outsourcing that decision to a professional manager. You're giving them a pool of capital, you're becoming a limited partner, and that manager, the management team, will bring their expertise, their due diligence, their deal sourcing capability, and make investments, monitor them, and essentially expect to give you a return over the period of time. Venture capital funds are for a certain term, and that term generally is 10 years. Sometimes it could be 8. But it sounds long. It is, because startup investment takes time, whether it's software, hard tech, physical AI, or a combination of all of that. Every company takes some time. So the one important thing to note is you don't have to wait until the end of 10 years. When there's M&A activity, even if some of them get lucky and grow really rapidly, they not lucky, but hard work is why, and they go public, you will get your distribution, you will get exits as you go along. They just don't expect them to happen in the early years. You need a few years before things start maturing. Can we go to the next slide? So this is sort of maybe the journey of both VC and private equity. What's the difference? But also let's get into what it takes to start a fund, and as you evaluate funds, understand what period they're in. So private equity is also another way you can play private markets. Typically in private equity, the investment is going into a company, and it could be that somebody's going to consolidate a number of different companies. So for instance, if you want to go buy a packaging company or accounting firms or dental practices, you could then buy several of them and then give them some sort of economies of scale, whether it's back office services, accounting, admin, sales, and marketing. This reduces costs, and the idea is we need fewer people, we can create efficiencies and then roll everything up. You could have one brand, you could have the separate brands operating, and eventually the PE manager will want to sell these assets. and either you sell them one at a time or as a whole. But the holding periods are less, right? So they could be 3 years, 5 years. And yeah, I mean, the returns are on par with venture capital. Sometimes PE will do better, sometimes VC will do better, depending on, are you looking at 10 years or 15 or 25? And right now, the public markets are looking fantastic. But the point is that things will always, some asset class will always outperform another. If you're diversified and you have a longer term approach, you want to have exposure to all of these things. Um, Now on the right side of this page, what does it mean to start a fund? Initially, you start a fund and you decide what your thesis is and so forth. You set up fund formation really deals with setting up, what state in the U.S. We're registered in Delaware. If we have a U.S. fund in Portugal, you're registered in Lisbon. In Portugal, it's the CMVM that approves your fund. In the US, you file with the SEC. Now, depending on each country, funds can have different rules, whether they need to be audited, how much of filing are you doing with the regulatory bodies, depends on fund size, etc. So once that is done, and even before that's actually done, fund managers raise capital. And raising capital, and I'll say this with a smile on my face, is a full-time job. Everyone's always raising capital. And fund managers like to deploy as fast as they can and then go back and start raising again. Sometimes they'll start raising in the middle of one fund, and you kind of have to. Um, as far as tailwinds and headwinds, so for my thesis right now, it's a tailwind. Advanced manufacturing, everyone seems to love it. We're reshoring. We've got tariffs to deal with. Why take components from China and build it in Mexico and ship it to Europe? So there is something to be said for let's reshore. But on the flip side of that coin, it's not that difficult. I mean, it's not that easy, is what I meant to say, to just take manufacturing and bring it back to a particular country. There's a lot of stuff that goes into it. It takes a long time. So these types of macro things can be headwinds or tailwinds. In the meantime, you've got things like the pandemic, you've got global challenges, you've got liquidity of investors. So raising capital is pretty much like trying to sail across the Atlantic every single day of your life, and every day there's going to be some new waves that you have to battle. Now, once you get enough capital and you start making investments, that's when fund managers generally, um, you know, like what they're doing because that's the whole point of being a VC. So you start investing, and the investment period is the number of years that you have, and you said this in your documents during fund formation, that I will make all of my investments in 5 years or 4 years. And typically what this means is I'll identify the 20 companies or the 25 companies that are going to be in my portfolio. You always have the ability to write additional checks beyond that period if the opportunity presents itself. So you keep some dry powder or some capital. Now, over the years, you'll have opportunities to divest when there are exit. You can't get out. Like as a fund, you can't tell a startup, hey, I want to get out. Once they're big enough and there's additional like later stage funding, then yes, some investors can take money off the table. Um, but in terms of who, that's sometimes a bit opaque. Um, on the flip side, an investor in a fund can't say, "Hey, you know what? I want to go buy an apartment. I'd like to get out of your fund." We've had this. We've had people ask us that, and we're like, "Hello, that's not how funds work. You have to stay the course, and that's what you need to be aware of before you sign up." So the liquidity events can happen as you go along. This curve that you're seeing is sometimes referred to as like a J curve, if you will. If you look at fund performance, sometimes the early years, you can start a little bit higher, positive, and then it'll dip below zero, and then you'll start coming back up as valuations improve. You actually have exits and so forth. Are there any questions on any of these things? Raquel, you can go to the next slide, but if there are questions, feel free to raise them, and I can also stop and give some color. Now, I've alluded to this, so there's early growth and later stage. And typically, when a company first starts out, they are called seed or pre-seed even. And when it's an idea at first, startups are generally in pre-seed. They're trying to figure out what it is they're going to build, whether it's software, hardware, and such. Seed is when they've built something. There's been some skin in the game. They've got MVPs, maybe not fully baked yet. If it's a physical product, they've built some prototypes. And then seed may have many different stages of seed. It may go on for a long time. So it's not like one and done. So you'll hear seed A, seed B, seed D, seed one, seed four. Um, so a lot of early stage investment is in that pre-seed and seed, and some also include Series A. So we're a seed and Series A company. In the first fund, we invested in some pre-seed. In the second fund, both in Portugal and in the US, we'll stick to seed and A. Um, Series B, C, and D are the growth stage. We've got some Series Bs in our first fund. Either we went a little bit outside the thesis and invested in the Series B because it made sense, or our seed companies, in the case of Throne, have now graduated to Series B. So a portfolio may have a combination of different companies. And obviously later stage would be, the ones that are ready for, IPO, and certainly acquisitions can happen, honestly, at every stage. You don't have to get to a certain number of size or even revenue. But certainly if companies are generating 5, 10, $15 million of revenue, they become interesting as acquisition targets. Sometimes in certain industries, it could be much later. It all depends on what you're investing in. Raquel? Next. So filling the void, the void of capital, where can capital come from? And these limited partners in a fund are individual investors. They can be folks that are making their first investment in a fund. It could be a group of people, like an angel group, who's decided that, hey, I'm going to gain exposure to a fund's thesis. It could be family offices that are going to invest almost, they can invest in funds, they can invest directly, they can do whatever they want. Then as you get into institutional, it could be endowments, it could be fund of funds. A fund of fund takes money from limited partners themselves and then turns around and invests in other funds. More and more, you see fund of funds investing both in other funds as well as directly. And sometimes they'll write a smaller check into a fund and a larger check into direct investments. That could be a strategy to save on fees or use a fund as a scout. So lots of things are happening in venture around limited partners. So I won't go too much deeper into that. Ask me questions and we can dig into it. Let's go to the next slide. Raquel? This slide is talking about various aspects of fund investing and what different things mean. So I'll just go through what each of these mean. Hopefully, it's not redundant or something that everyone is completely familiar with. I would love to just get a show of hands from folks in the room. Maybe drop in a comment if there's quite a bit of familiarity with everything, all the terms here, or if there's a term that you want me to explain, I'll try my best if it's not on this page. But fund size is basically the size of your fund, and the size can be small, it can be big. We at DiPaolo are raising a 30 to 50 million second fund in the US, a 20 million euro fund in Portugal. So the fund size is a number that can grow. Often people start with a smaller fund, like 5 million, 10 million. Then the next one, they make it bigger. Sometimes people start with 250 million. It just depends on, or I'm going to raise $1 billion fund. There are folks that are raising multiple billion-dollar funds. And sometimes I talk to them and I'm amazed at the difference in numbers between what they're doing and what we're doing. I mean, you would raise $1 billion for, say, data center infrastructure investments or something like that around infrastructure. That's when you'd have the larger funds. But you could also have VC funds investing in startups that are, $1 billion. The difference is most of the returns and the juice are in sub 100 million number funds because we're just working harder. We're schlepping around the Midwest. We're going to all sorts of geographies like Portugal, every state in the US where there's valuation arbitrage. You're working harder. When you have to deploy 500 million, $1 billion, you have to write much larger checks. You're not getting into seed stage. And while larger funds are obviously still, starting to play in the seed stage, emerging managers, first, second, third funds, are the ones that will find you lower entry points. That's just a fact, and that's what the data shows. Portfolio companies is the number of companies in your portfolio. Typically, you want to see at least 15, maybe up to 25. You don't want to see dozens and dozens of companies because the fund manager needs to spend a lot of time with each one of them, not just in diligencing and making an investment decision, but the many years later in supporting the portfolio. That's really why we invest. We want to help bring these companies to a much better outcome. It's not just about the check initially, right? Check size is as it is obvious is a check size. There's two check sizes. One is the check that the company the startups will get. So they typically depend on the fund strategy and how much money they have. So if I'm running a $30 million fund, I would want to write checks starting at 250, 500K, a million, maybe 2 million at most. If I'm running a $500 million fund, I need to write checks that are $25 million, right? Or $10 million. So sometimes the work is the same and that's why, managers want a larger fund so they can deploy more capital. But sometimes your startup can't take all that money. So this is has to be well thought through in terms of how you create a portfolio investing strategy. Follow-on ratio usually refers to what percentage of your capital you leave as dry powder to follow on to your portfolio companies. Some funds will leave more than 50%. Others will write a larger initial check and leave less. And the data actually shows that obviously, if you're writing a larger check initially, you're getting in at a lower valuation. And so you may have a better outcome, right? But if you wait and de-risk a company and wait for it to be a little bit bigger before you invest, that's not bad either. It's more of a sure bet. So it kind of is an interesting play, and different managers have different strategies around it. At DiPaolo, we've generally written more in the initial rounds and may leave, say, 40% or a third of the fund for follow-ons. But we've also followed on multiple times in whatever way we can when we have conviction. Startup stage, we already talked about. Seed and A is one strategy. B plus, Bs and Cs could be another strategy. Some people may only invest in the pre-seed stage. Capital calls is basically how you invest in the fund and over what period of time. So I said there were two check sizes. The other check size is your check into a fund. And that can be, say, $100,000 or $250,000 or 500,000 euros. And the capital call will determine whether you need to pay it over 3 years, 4 years, or all at once. So, for instance, there is a scenario where you have to pay all at once. Our fund that is in Portugal, if you are going for a golden visa and you need to make that investment into Portugal through our fund, you need to pay all at once. So it's a single capital call. Now, if you want to pay over time, great, but that investment in Portugal is not eligible for you to get your golden visa until you make the full investment of €500,000. In a US fund, more typically here, if you're going to make 100,000 investment in a fund and it's a 3-year capital call, you're going to expect to pay about 33 a year. But note that GPs and fund managers don't have a crystal ball of when they need money and how much. Some will call capital as they need it. Some will give you a little bit of a sense that, hey, I might call it twice a year, but you can't hold them to exactly a certain number and a certain size, because we don't like to keep a lot of cash in the bank, because that will reduce the next term here, the IRR. We call capital and deploy it, so our IRR, and your IRR as an LP doesn't go down. That is the rate of return. And your 100,000 into a fund, or 250, whatever it may be, basically isn't 100,000 from the very first day that you sign the subscription documents to get into the fund. It's those transfers. And so that's all calculated in the back end by the fund administration. So you're getting a higher IRR by having this capital call system than you would had you given me all of the 100,000 on day one. And then my fund's IRR wouldn't be as great, because I may be deploying $20,000 from that, and the other 80 is sitting in a bank, taking IRR down with it every day. So we don't like to keep big bank reserves. Sometimes you do, depends with on the fund. Not familiar with TVPI and DPI. Great, getting into that. So when you invest your 100K and the fund raises, say, $5 million, just to use a easy example, they tell you up front, like, our expenses and management fees. Management fees typically could be, say, 2% a year, which means over 10 years, that is 20%. So 20% might go to management fees. But so if you put in, if the fund is $5 million, that's $1 million going to management fees, and you might be like, wow, that's high. Well, there's a lot of work involved. There's also expenses, right? Every year there's expenses that the fund has to pay for: legal, accounting, initially organization, fundraising, and then there's team. So where does the team salary come from? Where does office rent come from? That comes from the management fee. So salaries and all of the things that you might need to do to run a fund on that, some of it is coming from the management fees, but a few professional services and administration and those things come from expenses. So in my example, say the fund has $5 million and it says, let's make the math easy, spend $1 million on fees and expenses. So it now has $4 million left. That $4 million, it'll invest into startups. So TVPI and MOIC, the difference is money over invested capital is MOIC. So I only have 4 million to invest. Say at some point in time, that portfolio, that 4 million grows to 5 million. So the fund is a $5 million fund. So TVPI refers to the 5 million as the denominator, and MOIC refers to the 4 million as the denominator. So if you think about it, MOIC would be 1.25 for that 1 million gain on the 4 million invested. And TVPI would be 1.0, because the total value, that 5 million of this portfolio, is the same as what people paid in, which is 5 million. So over time, TVPI becomes more important, and MOIC and TVPI sort of converge. So later in life, basically all that an investor should care about is, yeah, tell me what the overall, I gave you 100,000, I gave you 5 million, how much is it now? So if I'm trying to beat the market, that 5 million should become at least 10, because generally the S&P 500 over 7 or 8 years doubles. So if you're not beating that 2x, then you're not going to do very well. Most fund managers struggle to even beat the 2x. You have to have differentiation. You have to really be good at what you're doing. There has to be a reason that you're getting those deals. But if you do, then 3x, 4x, 5x, all of these are possible. But don't be fooled by this notion that everybody in venture is chasing 10x or even 5x. Very few managers can deliver that. If you were delivering 3x, you'd be in the top 10%, 20% of fund managers. So take it all with a grain of salt. Nobody can make money that magically. DPI is the final thing, and this means distributions to paid in capital. At the end of the day, it's a ratio. So I gave you 100K, I gave you 5 million. How much of that do I have back? And for a long time, this stays at exactly 0.0, because you're not getting things back in the first year or the second year or the third year. You're waiting, right? But over time, it starts to come back to you. So how much of that investment what percentage have you got back? Over my 10 years of angel and fund investing, including my own funds, my DPI at the moment is 0.64. That means of all the money that I put into all kinds of startup investing, I've got 64% back. So that's a pretty decent number for myself personally. My fund one DPI is a lot less. Most of the funds I'm in, there's one where my DPI is it's over one. So I've got all my principal and then some, and there's more to go. So we love that fund. But there are others where the DPI, I mean, 8 years in, my DPI is zero. Still waiting. Okay, I think I'm going to get off this slide. Were there any questions? Jump in. There's one here, about 50% of the terms are familiar, the ones on the right hand. Okay, so does everyone feel good about these explanations? I'm going to move on because we're going to run out of time. Let's go. So investment thesis is important when you look at a fund. Make sure that there is expertise in the manager, right? Everybody wants to start a venture fund. Not everybody, but many people that I work with. Maybe you guys do as well. Talk to me. Let's get, therapy together if you want to start a new venture platform. It's a lot of work, but make sure that GPs have expertise. Our expertise, for example, is we know manufacturing, we know hard tech, we've built products, we've been founders. So I take that knowledge and my partners take that knowledge and we bring it to the startups and to the whole process. So having focus areas, again, some definition around what is your stage? How are you going to construct your portfolio? How much of your investments are going to be first checks versus follow-ons? Geography, I can't invest all around the world. I mean, how would I? How would I add any value if I said, okay, I'm a global investor everywhere? I add value in Portugal because I have a team that's present there. I have a private equity firm that's running, hundreds of millions of dollars, and they're partners with us there. I have Raquel, who's from Portugal. I'm ingrained in that ecosystem. I have leverage in the US. I have distribution in some parts of the world where my US companies may be building great products that we can now ship to Asia or help them sell into Africa. So there are things that, is in everybody's sort of toolkit in terms of why you would like a particular fund. We can keep going. Raquel? I don't have any control of the slides. Raquel, are you there? Yeah, so the fund manager now, putting on the hat of the fund manager, what are the major steps in choosing an investment? As an LP, you're not really involved with that, right? But you should know what, how a fund works. How are they going to pick these companies? What's their sourcing? How are they going to get deals? And if you're in the investment business, if you want to look at my inbox, which I'll be happy to share, every day there's dozens and dozens and dozens of deals, most of them unsolicited, most of them that don't fit, and most of them, you have to use AI now to screen all this stuff. But the quality introductions from other investors or from networks. So if you're going into, university research-led investments, then you want to have a lot of university research contacts, right? You want to be tied in with the national labs. If you're trying to invest in coding tools, then you need to be aware of what's happening out in San Francisco because that's where all the coding tools are getting made. So it just depends. In Portugal, if you want to invest in water or in food and in renewables, there's lots and lots of deals that you can come across. But the next step is to screen them, obviously, and you can do it manually, but more and more firms are using some level of AI and sorting, and we do as well. We're starting to build our models out. The diligence, though, requires a fair amount of human intervention. Yes, you can use ChatGPT to create some kind of initial analysis of a pitch deck and even review financials. But at the end of the day, people have to do their own diligence. You need to visit with the team. You need to, during the pandemic, there were people, and then still today, I guess you may not meet every portfolio company that you invest in, but at DePaulo, we like to know who we're dealing with. It's a long-term relationship. And then finally, the decision is actually made by what's called an investment committee. So it's rarely just, the single person that's maybe the face of the firm or the GPs. there's always two or three other people, or it can differ. You want an uneven number of people in the investment committee. They bring some expertise, and there's some rules about their own process. Each firm is different. Raquel, moving on. These next two slides, I mean, so essentially, like, what are the things, there's always screening criteria. Each firm has its own. You could look at the problem. What problem are they solving? Is it impactful enough? What's their market size? Do they, and there are parameters to help screen out deals, right? Startups can be great, but it may not fit your fund because they're in the wrong area, or they are raising too much capital, or the valuation is too high. But you're also looking at things like, is this team credible? Is this the right team to solve this problem, and why, right? Um, we all want to see traction. Traction can mean different things. You've built some prototypes. You have a pilot. You have a customer. Um, we are impactful investors. So first of all, I'm looking at great businesses that don't require subsidies and federal grants. I mean, they may have had grants because they're all science-based. So sure, that's great, but ultimately they have to solve a problem that a business wants to pay for, or a consumer wants to pay for. And they have to, by doing that, they're creating impact. So, I think impact for me is a big word. A lot of people think about impact and it's not never going to make any business sense. No, good businesses should be creating great impact. We always look for red flags. I was almost ready to invest in something and found out there was a lawsuit that the founder did not disclose. And this came up because our investment committee actually, there was somebody that knew about this. So you lean into the village to sometimes find things that did not unearth in the initial scan. Anyway, we have lots of models and memos, right? At the end of the day, financial models you have to take with a grain of salt. A startup without any revenues that is just building products, you cannot do traditional financial modeling that you can with established companies with revenue projections and all of that, right? Most of the revenue projections have to be taken down. So there's a lot of discounting. If you say you're going to make $10 million in year two, I will discount that down severely. So there's many things we look at. The memo is the overall sort of presentation of all of the facts to the investment committee as part of the decision. Raquel, moving on. I'm going to skip over this because I think we've talked about it. So now choosing the right fund for you. I think by now, hopefully you get the sense, like know what your own goals are, and then what your risk and investment goal is. I think one of the things that people really like to do is invest in things that they appreciate. So if you like advanced manufacturing, you might invest in my fund. Or if you appreciate that this is a growing space, you might invest in it. But if you say, I really hate hardware because hardware is hard and it takes too much CapEx, and I really like enterprise SaaS, then I'm not the fund manager for you. Don't waste your time or mine, and it's fine. We can be friends. So you also obviously are scrutinizing the fund manager and the team investment strategy. We talked about, I explained a little bit about the management fee. The thing that I didn't get into is carried interest. What that means is the share of the profits. And very simply, most funds will not let, but the way that it's set up is the investor gets their principal back, and then they will take 80% of the profits, and the GP or the management company will take 20. Sometimes there's variations, but that's a very tried and tested thing. In private investments, you'll hear the term 2 and 20. What that means is 2% management fee per year, 20% carried interest. Now, sometimes smaller funds might have a 2.5% charge. So if I'm running $1 billion, 2% should be more than enough. You could, probably run it for a lot less. If I'm running 10 million or 30 million or 2 million, then, the 2.5 versus the 2 makes a big difference. Understanding liquidity lock-in periods, we talked about that. And then, basically who is the regulatory supervisor for a fund? What kind of auditing are they going to be doing? When do they give you your statements? Is it quarterly? Is it twice a year? So these are the things What are the taxes? Do you get a K1 from Europe? You might get a PFIC, and then what is that? Uh, so understand those things as before you make an investment. So using DePaulo as a case study, this is our platform. We did a first fund in the US in 2020. It was a proof of concept, if you will, around our ability to help companies through all this technical expertise I alluded to. We made 14 investments, Geobit exited, so seed and then Series A with a little opportunistic. And now we're doing fund two. But in between, we had this vehicle called the Opportunity SPV, which almost acts like a mini pool. And we get the best sort of growing companies out of fund one or anything else that we find compelling. And we write 25 to 50K investments into those deals. As an investor, people can put in 25K, they can put in a little bit less if they want to. We're going to close it at the end of the year and likely start another one next year. But that has a 5-year term. Why? Because these are more mature than when we first invested in them. But with any fund, if you need more time, you go back to your LPs and you sort of get permission to continue. And then there's fund two, and then the DePaulo Heat Fund. So let's just spend 2 minutes on the DePaulo Heat Fund. It's based in Portugal. It's a great way to get your golden visa if you're interested in that. 60% of the fund would be invested in Portugal, 40% would be elsewhere, and part of that might come back into our fund two in the US. Minimum investment is 500K. There are people that will invest in that fund without getting a golden visa. For them, the minimum would be less. Minimum for the Portuguese golden visa is 500K. The fund itself is a 200 and 250 minimum based on which share class you go into. Raquel, I'm going to also, we're at the hour mark. So I think, I don't know how many more slides we have. Can you come off mute? Let's go to the next couple of slides. And I think
Sure.
see if there's any other final questions. I think I've covered all of this for the DePaulo Heat Fund. I'd like to see if anybody has any questions rather than we'll send you this deck. So I'm not sure that everyone here is interested in the golden visa, but it's one of the things we do. If you're interested in US funds, then we do that. And if you're not interested in any funds at all, that's fine. I hope this was helpful to people. And by all means, go out there. If you're getting started, write a small check. I mean, get involved with an angel group. It's the most exciting thing because how else can we ever touch and feel these innovations and these great teams that are out there, right? And be patient. Overall, be patient with the ecosystem because what we don't want are people that are like, comparing this to real estate. I want to flip my apartment next year. No, that's not how it works. Have a longer term mindset. I'll leave you with that. I have to go talk to a bunch of water tech startups here at MHub. If there are any questions, contact Raquel, contact me. Thank you so much for joining.
Thank you, everyone. And I'll be sharing the recording by email. Thank you so much.
Next time I'll be faster. Sorry about that. Okay.